What the heck is seller financing, and can you use it on your next rental or even a house hack? Well, in today's episode, I'm going to teach you the basics of seller financing, going deeper into this strategy from episode 7. But beyond that, I'm going to give you 5 specific things that you need to know to look out for when you're negotiating with the seller on this kind of deal. And I'm going to help you protect yourself legally, even though I'm not a lawyer. If you want one, go get one. Something you really need to get in order for this to work. So stick around because it's all you need to know in one episode. We start right now. Welcome back, everybody, to the Property Squad. And this is a real estate podcast about investing, stories, and strategy. Each week, I interview someone who has had investing success, their trials, their lessons learned, basically their story. In the next episode, I break down their strategy and dive deeper into it using my knowledge and expertise. And my name, if you don't know, is Anson Young. I've been around for a while, for 17 years as an investor and agent. I'm doing fix and flips, wholesales, and BRRRR deals in 4 different markets. And I'm also a BiggerPockets author, a speaker, and if you don't know, I have 2 dogs. They're Lily and Ginger. They're good dogs. I'm just gonna throw in random facts about me until the end of time. So stick with it. Check out our socials in the links below and check out propertysquadhq.com, which will be ever evolving and adding as many free resources as I can pack in there. And hopefully next week I'll have an announcement of something new that's being thrown in there. And also down below is my favorite resource, all of the vendors and tools that I use on a daily basis inside my real estate company. I just added a new fix and flip and BRRRR deal analyzer from a company whose spreadsheets I've been using for like 6 years. I just realized that they have another software that does the same thing, but even better. It's helped me do over 100 flips. So check that out down below. It's called Flipper Force. It's really cool. Welcome to season 1, which is all about house hacking. And real quick, house hacking is where you buy a property to live in, a single family, duplex, triplex, fourplex. You live in one part of the property, you rent out the rest. So you live in the room, rent out the other rooms. You live on one side of the duplex, rent out the other side of the duplex. You get it. The idea is that the renters will be paying for some or all of your mortgage, offsetting your housing expense so that you can go on and buy another house in a year or go on vacation or pay off debt. It's honestly one of the best and easiest strategies to get started in any kind of real estate that you want to do. So this is a strategy episode. So let's break down how Tanner did it so that you can apply that to your own success. Let's go. So at first, we're just going to have to break down what seller financing really is. In a traditional home purchase, you go into the bank or you get with your mortgage lender, you apply for the loan, you go through their underwriting practices, they go through your tax returns, they go through your bank statements, they go through your credit, they get an appraisal to protect their investment, and you have to go through the entire loan approval process. Well, in seller financing, the seller extends a loan to you directly, and then you make payments to the seller instead of to the bank. So think of it as an installment plan for your home where you don't have to then get approval from a bank. This usually means that the seller has to own the house outright with no mortgage on it. Usually the title company or the closing attorney is going to want to pay off all of the previous liens in order to transfer clear title over to you. So typically seller financing, they have to own the property 100%, no loans, no mortgages, so that they can then extend that mortgage instrument to you so that you're making payments to them instead of to the bank. You can't really do that if half of their equity is tied up with a loan. The title company is not going to want to issue clear title on something that has an existing loan on it. And so typically free and clear. There's a slight exception, and that's if you're buying the house subject to the existing mortgage. That's a very advanced, rare, and complex topic we could definitely save for a later date. So keep that in mind. Typically free and clear. There are a couple of really niche ways to go about it if they have a loan on it, but let's not get into the weeds today. Okay, so they own the house free and clear, and instead of taking their entire equity as a big chunk at closing, they are now acting as the bank and taking their equity in smaller installments. That means that you are now not just negotiating the price, the inspection items, the closing schedule, all of your normal real estate transaction things, but now all of the loan terms are negotiable as well, which we'll definitely get to in a minute. So why would you, as the buyer, want to get into a seller finance property? So first of all, qualifying for the loan now just becomes whatever the seller is comfortable with. Some will want to see credit or at least know you have a job, and some won't. Really, it's kind of the Wild West out there. Some sellers are savvy and some are good with just a handshake, which you should honestly never do. You should make sure you get it on contracts, which we'll cover in a bit. The second reason is the closing speed. Since you don't have to deal with the banks, underwriters, and loan approval process, you can close in as little as time as it takes for title to be ready, which is kind of nice. You don't have to wait for the bank to say yes. And thirdly, you can negotiate so many more aspects, such as the down payment, the interest rate. You can sometimes pay more for a property because the interest rate is lower than the market. So sometimes you can just take that into account when you're running numbers on the deal. Now you can actually play with the interest rate, which with a bank, you can't really play with the interest rate. They're going to tell you no every time. So on the other side, why would a seller want to do owner financing? And usually it boils down to tax reasons or other reasons why they can't take a lump sum payment at closing for their equity. The payments over time could work better for them during retirement, where getting a big chunk of money can interfere with Medicare and some other things where they can't show, kind of a giant lump sum of money in their bank account. There are really a dozen reasons why a seller would go this route. It's not as uncommon as you think, honestly. And real quick, if you're looking for owner finance opportunities, a lot of times they'll be listed on MLS or on Zillow, Fizbo, those kind of sites where it says owner will carry, seller finance, owner finance. That's where the owner and the agent or just the owner have raised their hands and they're saying, look, I know what seller financing is, and I'm willing to do this, right? And that's Tanner's story. There was a listing where this was being offered. And in other cases, it's usually an off-market property, so something that's not listed. And you're going to the seller and you're saying, look, here's an option that you may not have considered that you don't even know exists. Instead of taking the full amount at closing, you act as the bank and you have to kind of sell them on it. So it's either they're raising their hand and they're saying, yes, let's do it, or you're the one who's proposing the idea. And typically that's, again, not listed properties. Because usually if you go to a listed property and you say, look, you can be the bank, their agent might have a problem with it. They have no idea what's going on. So those are the kind of two scenarios that you're looking at. All right, let's get into those 5 terms that you should look out for when negotiating. The first one is the length of the loan. This is pretty important because a 75-year-old seller may not want to give you a 30-year loan for obvious reasons. This is where you can also play with spreading out the amortization. So this is your interest rate amortization over the course of 30 years, but the loan might be actually shorter. The loan term might be 5 years, 10 years, 15 years, somewhere in that range, so that 75-year-old seller doesn't have to wait 30 years for the whole thing to be paid off. This makes the loan actually due in a shorter time. So let's just go with 10 years. This is called a balloon, where the loan pops and it explodes after those 10 years and the full remaining amount is due. So if your payment is $2,000 a month, you would have $2,000 a month for 10 years. That very last payment would be the remainder of what is due. So it could be $400,000, boom, at that last payment. So just be aware of how these things are structured and what makes the most sense for you. This typically just means that you'll have to refinance out of that seller balloon loan into a bank loan. So the seller gets those payments for 10 years. They get the rest as a lump sum. As an 85-year-old now, after those 10 years, they can take that lump sum and, live out the rest of their days in their $400,000 happiness, whatever that looks like. So just know that those are two different things. You have your interest rate schedule, your amortization schedule, and then you have actually the loan term. And typically on seller finance, not everybody's going to want to give you a 30-year term on that loan. It's going to pop after a few years or 10 years, somewhere around there. All right, second thing is the interest rate. So unlike the bank, where the interest rates are set by the market, the rate on a seller finance loan can be anything that you and the seller agree to. So it could be 4%, like Tanner from episode 7 got, or it could be higher, depending on where the seller's comfortable with. This is actually really interesting to be able to negotiate the interest rate on a loan. So those payments will be much different. The deal looks much different. The cash flow is much different. Whereas if you go to a bank, they just have that market rate. You could play with it a little bit with buying down the rate, things like that. But for the most part, you can't just go in and say, let's do a 4% loan. Come on, bank guy. Let's do a 4% loan. Come on, mortgage broker. Give me 4%. It just is not going to happen. So in this case, Tanner has a second loan on the property on his fourplex. And this was for a certain percentage of the down payment. I think it was like half the down payment. The interest rate was 9%, right? So they have a first mortgage for 4%. They have a second mortgage for 9%. You might be saying, holy cow, that's like 3 or 4 points above market. But that is actually a shorter term. It's only an 18-month loan. And the seller's taking more risk because Tanner's not just coming in and saying, look, you're going to loan 80%. Now it's closer to 90, 95%. So that extra risk on the seller's part, they're asking for more interest rate to cover that risk. And so with that 18-month balloon, he has to know from minute one that he needs to get out of that loan in 18 months. So a refinance, a HELOC, something like that. So negotiate those interest rates. The third term is if your payment is interest only, or does it include a principal? So on the 9% loan that we just talked about, it's set up as interest only, which will make the payment smaller, but he still owes that same principal amount. So if he borrowed $100,000 in 18 months, he'll still owe $100,000 because his payment isn't going towards that initial principal amount. So on a normal loan, normal bank loan, you are actually taking chunks out of your principal with every payment. You're paying some interest, you're paying some principal, you're paying some interest, you're paying some principal. So after the course of 10, 20 years, you have paid off a chunk of your principal and you have even more equity. Whereas an interest-only loan, you're only paying the interest rate. You're not taking chunks out of the principal. So just know what you're getting yourself into, really. On a larger loan or a longer loan of 5 years, 10 years, you probably want to pay some of that principal of the loan down with each payment. This will increase your equity over time. There are scenarios where you would just take a 10-year interest-only loan. That would be if the cash flow is just insane, or if you're in a high appreciating market where, over the course of those 10 years, you are going to see a significant bump in your equity due to appreciation. So keep all that in mind. Let's go to the next one. The next one is the down payment. So this is, again, fully negotiable. Some sellers will want to see some money down. Some sellers are offering a loan for the down payment. So I just did a deal analysis video with Noah over at BiggerPockets Rookie YouTube. And that deal, in that scenario, they got a bank loan for 75% of the purchase price. And then the seller did basically a down payment loan, a second loan on that property, which was 4%. I believe it was for 5 years, but that means that investor came into the deal with no money out of pocket. The bank gave 75% and the seller carried back another 25% at 4% interest. And so that could be a really good deal because you're coming in no money down, and he got a killer deal. Tanner got that 9% loan. This investor, I think his name is Adam, got a 4% loan for his down payment, which is pretty sweet. So all of that's negotiable. Down payment, it's going to just be what you're comfortable with, what the seller's comfortable with. The fifth thing is an appraisal. So the bank will actually require an appraisal to protect its money. They want to know that the house is worth more than they're lending on. That makes sense, right? So I believe that you as the buyer in this scenario should also get an appraisal for your own peace of mind and your own due diligence so that you're smart about the money that you're borrowing from the seller. So an appraisal costs $400 to $800, and it'll give you a peace of mind that the value of the property is verified to be higher than the loan that you're taking out. And it also gives you some good ideas on future options. So if you have a short balloon that's coming up, let's just say that 18-month balloon, you can go into it from day one knowing that you do have room and equity into that property that you'll be able to refinance out. So you're getting that loan from the seller for $400,000, but it appraised for $450,000. You know that at that time, there's about $50,000 of room, and you know kind of where you need to be for getting out of, a short-term loan. So that $400 to $800 is a small price to pay, knowing that you're going in with some equity and that you're not taking a giant risk and upside down from minute one. So if you take out that $400,000 seller finance loan and it only appraises for $350,000, that could be a problem for you. All right. So I can't talk about seller financing without talking about how you can protect yourself and the seller with kind of two documents that we're going to talk about. The first one is a promissory note. The next one is a deed of trust or a mortgage, depending on the area that you're in. They're two different things. Different states do it different ways. So the promissory note is a legal document that contains a written agreement between the borrower and the lender so that the borrower will repay the amount borrowed plus interest, right? It's all of those things that we just negotiated for, all inside of a legal document. So that we're not just doing that handshake deal. It's all spelled out in the document. This will be your interest rate, your balloon, your repayment schedule, all of that fun stuff. And the deed of trust, this is something, it's not totally specific to Colorado, but this is where real estate purchases, which the purchaser borrows money to pay for the property, and it's typically secured with a deed of trust. Whereas a mortgage, the parties are the borrower and the lender. In a deed of trust, it's a three-party agreement between the borrower, the lender, and the county public trustee. So it spells out what happens if you miss payments, or possibly even what happens if the seller dies. So if somebody at the bank dies, your mortgage lender at the bank dies, it's unfortunate, but the bank holds that note, right? In a seller finance situation, this is an individual. So if the individual doesn't have, any kind of succession of where that note goes to, the deed of trust and the promissory note should spell out what happens if something happens to the actual seller, which in this case is the lender. Both of these documents are recorded at the county so that it's not just, again, that handshake agreement or that these are in a drawer somewhere. These are actually recorded legal documents. And so if this sounds complicated, secured legal documents with all these terms, you should follow this number one main tip. If you're not experienced with these things, get legal help. So your title company, your real estate attorney, your closing attorney, they can help you navigate all of these things. And I'm going to say, it's not going to hurt to have a lawyer look over all of these things so that you are protected. So don't go it alone. These are very powerful legal contracts with real world consequences to you and your business. So seriously, get a professional. If you want more actionable info like this, please be sure to follow us on YouTube, Spotify, those fun places. Check out Tanner's episode where his owner-financed quadplex house hack brings in $145,000 per year. That's episode 7. The squad needs you, so join up. Check out propertysquadhq.com. Check out the list of tools that I use in my real estate business down in the show notes, down below. And until next time, seriously, owner financing is super cool, but please get a lawyer to help out. That's like 4 disclosures I made for legal. You can't say I didn't warn you. Get a lawyer, seriously. And until then, happy investing.